Good day to all of you. Today we'll be revising IND AS 20 Accounting for Government Grants and Disclosure for Government Assistance. A relatively very simple standard, so we'll be able to quickly revise the same. As you know, the objective of this video series is to give you a pilot view of the entire standard, and for this purpose, we have divided the various principles of the standards as concepts. Right? So without any further delay, let's get into the revision. So let's start with concept number 1, the meaning of government grant. So, government grant is generally also referred to as subsidies, subventions, or premiums, as you would have already heard. And they are nothing but assistance that are given by the government. Government grants are assistance that are given by the government by transfer of resources to the entity in return of some compliance with certain conditions relating to the operating activity. Let's suppose the government gives you a grant of 50 lakhs and it says that you need to set up your industry, let's say in a backward area, right? So what does it say? Government will transfer resources to you, okay, in return of some compliance. You need to comply with something, certain conditions that the government has put forward, which is related to your operating activity, right? That is what is known as government grant. Assistance by government by transfer of resources to the entity in return of some compliance with certain conditions relating to the operating activities. Now, this is the general definition of government grants, but there are some specific exclusions from government grants as well. Let's look at that. The standard says that this excludes assistance which cannot have a value placed upon it. If you are receiving any assistance from the government, but you cannot place a value upon it, for example, technical or marketing advices, right, is a very common example. Let's say the government says you are, let's say, developing a vaccine, right, let's say, which can cure a very very dangerous disease, right? So the government says, in case you require any technical assistance, we'll give you assistance to contact the doctor at the aims, okay, and get further knowledge about the same. So the government is coming forward to provide you technical assistance, but you cannot place any value upon it, right? So any assistance on which value cannot be placed or cannot be determined, that will be excluded from the definition of government grants under IND AS 20, right? Similarly, it also excludes transaction which cannot be distinguished from normal trading transaction of the entity. For example, you are into the business of imports and exports, let's say, right? So the government is bringing up some import policies, right? So now these policies are obviously going to make your trade easier, and they are assistance by the government, yes, but can it be differentiated, can it be distinguished from the normal trading transaction? The answer is no, right? So such policies that are framed by government can also not come under the definition of government grants under IND AS 20, right? I hope it's very clear. So government grants, as you would have already heard, are common words that it are referred to as are subsidies, subventions, and premiums, right? But they are nothing but, in simple terms, assistance that are given by the government by transferring some resources in return of some compliance that you need to do of certain conditions relating to your operating activity. The standard very clearly excludes two things here. First is, in case any assistance is given by the government for which you cannot place a value, then that will not be covered under IND AS 20. Similarly, if there is a transaction which cannot be distinguished from the normal trading transaction of the entity, then that will also not fall under the definition of IND AS 20, right? So that is all about the definition concept. Now coming to concept number 2, recognition of government grants. When will you recognize this government grants in your book? The standard says that the government grant should be recognized only when there is a reasonable assurance, only when you have a reasonable assurance that the entity will comply with the condition of the grant, right? Obviously, we read in government grant that in return of the transfer of resources, the government will want you to comply with certain conditions relating to your operating activity. So the standard says only when you are 100% sure, only when you're sure that you're going to comply with that condition that the government has put forward, and you will definitely receive the grant from the government. At that point, you can record the government grant in your books. At that point, you can record the government grant in your book. So what does the standard say? The recognition criteria says that you can recognize the government grant when you have a reasonable assurance that the grant will be received. When do you have a reasonable assurance? When the entity is sure that it will comply with the condition that is being put forward by the government, and it will also receive the grant amount. It will also receive the grant, either the resource resources or the money, right? Whatever it is, the resource will be received. When the grant will be received, when it is sure about it, it can recognize it in its books. This means that a grant can even be recognized in the year of application for the grant by the entity without receiving it. Obviously, if you want a grant, what you do is you apply to the government, right? So when you have applied to the government, that is, it's a year of application. You have only applied, you have not yet received the grant. The standard says you can still recognize this in your books if you are certain that you will comply with the condition, and if you are also certain that the grant will be received. If both of these conditions are satisfied, even in the year of application, you have still not received the amount. Even in the year of application, you can still, book this or recognize this government grant in your books. You can still recognize this government grant in your books, right? So that is all about concept number 2. Moving on to concept number 3, grants relating to assets, whose primary condition is that entity should purchase, either it should purchase or either it should construct or otherwise it should acquire long-term assets. Subsidiary condition may also be attached, like restricting type or location of asset or period for which it is to be held, right? So in case you have these two conditions, and in case your grant is received in cash, in the form of cash, then how will you treat it? So treatment when grant is received in the form of cash, there are primarily two methods of treatment. Let's see the first method. Let's see method 2 first, since it's relatively smaller. It says method 2, in irrespective of whether your asset is depreciable or non-depreciable, against that you have received a grant which is in the form of cash, the standard says deduct that from the cost of the asset, and if it is depreciable, depreciation will be on the net value. Let's say your assets value is 10 lakh and you have received a grant of 3 lakhs. You have received a grant of 3 lakh rupees. So the standard says in method 2, irrespective of whether it's depreciable, non-depreciable, directly you can deduct it from the cost of the asset, So what is the cost of the asset? 10 lakh. How much government grant did I receive? 3 lakhs. So the standard says you can directly adjust it with your cost of the asset and it will become 7 lakhs now. Now let's suppose my depreciation is for 10 years. Okay, I have depreciation, the asset's useful life is 10 years and depreciation is on straight line basis. So the standard says then your depreciation will be charged on this net value. Depreciation will be charged on this net value, right? This is what is your method number 2. Very easy. Directly adjusted with the cost of the asset. Directly deducted with the cost of the asset. In method number 1 that you're going to see, there are two types. You need to first very clearly differentiate whether it's a depreciable asset or whether it's a non-depreciable asset. In method number 1, what do you need to do? You need to very clearly differentiate whether it's a depreciable asset or it's a non-depreciable asset. In case your asset against which you have received the government grant in cash is a depreciable asset, the grant will be deferred and shown in the balance sheet under other equity. You will defer the grant and show it as what? It will be deferred and shown in the balance sheet under other equity, and it will be taken to P&L as income in each period in the ratio of depreciation over the useful life. So in the ratio of the depreciation, let's say it's for 10 years, okay, and the depreciation is let's say 10%. So in that ratio, you will take that deferred government grant to your P&L income, right? In deferred, you proportionately you will take it in the ratio of your depreciation because it's a depreciable asset. So the first is, in case it's the depreciable asset and you're following the method 1, the entire government grant will be deferred and it will be taken to the balance sheet and shown in other equity. And in the ratio of your depreciation, that particular deferred asset, deferred government grant will be taken to your P&L. That will be taken to your P&L, right? Relatively easier. Next comes, in case it's a non-depreciable asset, then you need to look at one more condition. Is there any obligation that is being attached to the grant, right? You are supposed to fulfill this condition, or let's say you have received a government grant of 50 lakhs and they say using this 50 lakh, you are supposed to only set up a factory in this particular location. So if there is any obligation attached to the grant, or there is no obligation attached to the grant, the government has given you 50 lakhs, they tell for whatever purpose you want, you can use it, right? In that business, for whatever purpose you want, you can use it. So whether there's an obligation attached to the government grant or whether there is no obligation attached to the government grant is what you will look in case it's a non-depreciable asset. In case there's an obligation attached to that government grant, you will defer that grant and it will be taken to P&L in each period in the rate of obligation. You can't here take at the rate of depreciation because it's a non-depreciable asset. Let's suppose land. So in that case, in the rate of obligation, you will take it to the P&L. You will take it to the P&L, right? Similarly, if the grant does not have any obligation, there's no obligation attached. You can use it however you want. The standard says directly take the entire amount of the grant to your P&L as income immediately. Take it to your P&L as income immediately, right? So in case you have received a government grant in the form of cash, the second method to treatment says irrespective of whether it's a depreciable asset or non-depreciable asset, directly adjust the cost, directly adjust the grant that is received with the cost of that particular asset. And in case it's a depreciable asset, then the depreciation will be then charged on the net value. In case you go with the method one, then you need to check whether it's a depreciable asset or it's a non-depreciable asset. If it's a depreciable asset, then the grant will be deferred and it will be taken to balance sheet under other equities, and each year in the proportion or in the ratio of your depreciation, this grant will be taken to your P&L. And in case it's a non-depreciable asset, you need to check for one more condition, whether there's any obligation attached to this grant or whether there's no obligation attached to this grant. If there is an obligation attached to the grant, then this will be deferred initially and it will be taken to P&L in the ratio of obligation, in the ratio of obligation, right? And in case the grant does not have any obligation, then the standard very clearly says directly you can take the entire amount to the P&L. Directly you can take the entire amount to the P&L, right? Next is treatment of grant in case it is received in kind. Treatment of grant in case it is received in grant. So method 2 says that the asset will be recovered at nominal value, price paid to the government by the entity to acquire the asset, right? So let's say an asset, there's a machinery, okay, you are setting up a factory in a rural area. So the government says that it will give you a grant in the form of the machinery setup that you require, the government will give that. So actual price of the machinery, let's say, is 10 lakhs, but the government only asks you to pay how much? 20,000. Okay, so in that case, the standard says the asset will be recorded at the nominal value, that is this 20,000, that is price that is being paid by the entity to acquire the asset, price that is being paid by the entity to acquire the asset, and the depreciation will be charged on this nominal value. Let's say you estimate that the useful life of the asset is 10 years, so depreciation will be charged over a period of 10 years on this 20,000 rupees, right? Not on 10 lakhs, not on 10 lakhs. On that nominal value, you will charge the depreciation, right? Now, method 1 says assets and grant both are recorded at fair value. Assets and grant both are recorded at fair value. Let's look at it. First, in case it's a depreciable asset, the grant will be initially deferred and it will be taken to P&L as income in each period in the ratio of the depreciation, in ratio of your depreciation, right? And in case it's a non-depreciable asset, you will again check whether the grant requires, is there any obligation attached to it, or if there is no obligation. If there is any obligation attached to it, initially you will defer it and then it will be taken to P&L in each year, in each period in the ratio of its obligation. And in case it does not have any obligation attached to it, then directly the entire amount will be taken to P&L. Directly it will be taken to P&L, right? Next comes repayment of government grant. Next comes what? Repayment of government grant. In case initially, okay, now you have, let's say you had initially received a government grant, but you had done, let's say, they had some conditions, right? So you do not adhere to the conditions. So now the government wants you to repay the government grant. So then the standard says that if the grant, so then the standard says, in case the grant was recorded as a deduction from cost, the method 2 that we see, right? You deduct it from your cost. Then the repayment is recorded by increasing the carrying amount of the assets. Then the standard says, initially, how did you record the government grant? By deducting the value from the cost of the asset, right? So the government grant says, when you're going to repay, then just increase the carrying amount of the asset with the same amount. The depreciation will be on the increased amount of the asset prospectively over the remaining useful life. So in case after 8 years, let's say the asset's useful life was 10 years, and after 8 years, the government comes to know that you have not adhered to the condition of that particular grant, so it asks you to repay. So initially, what did you do? You adjusted the government grant's amount with the cost of the asset. So similarly, what you will do now, you will add it back to the cost of the asset, and remaining 2 years is the useful life, you will depreciate it over the useful life of the asset, right? And in case the grant was recorded as a deferred income, in case it was recorded as a deferred income, first what you will do, by reducing the deferred income balance, first whatever deferred income that you have still not taken it to P&L, right? So that deferred income will be there. So first you will reduce it from the deferred income, and remaining what you would have done earlier, you would have taken proportionately to P&L. So now this remaining amount you charge it to P&L. Now this remaining amount you charge it to P&L is what the standard says. Okay, and there'll be no effect on the cost of the asset, or depreciation will not be affected, because initially when that government grant received and when I was doing accounting for that, I did not touch the cost of the asset, right? So now also I'm not going to touch the cost of the asset. Initially the income was deferred, so how much ever deferred income is left, first you reduce from that, and then whatever amount is still left, okay, it's still remaining, then you have to adjust, then you have to take it to your P&L, then you have to take it to your P&L. Okay, in case the grant was recorded directly in P&L as income, in case you directly recorded it as P&L and as income, now you will directly debit it in your P&L. Now the repayment will be entirely charged in your P&L, and no effect will be on the cost of the asset or depreciation. Right? I hope so. Depending on the initial treatment, the repayment will be treated. Depending on the initial payment, the repayment will be treated. Right? Now, in case government grants related to any income is received, grant for expenses and losses already incurred and grant as an income, as an immediate financial support, grant for expenses and losses that has been already incurred, or grant as an immediate financial support you are receiving, then you will recognize it in P&L as income immediately in the period in which it becomes receivable. And in all other cases, it will be recognized in P&L as income on a systematic basis over the period in which the entity recognizes the related cost for that grant. In case the entity recognizes the related cost for that particular grant, basically you will defer the grant, guys. Basically what you will do, you will defer the grant. Initially, in the first method, you will entirely take it to the P&L. In the second method, you will defer the grant. Next is presentation in P&L. So, okay, government grant usually disclosure and presentation is very important points to be remembered. Okay, in presentation in P&L, method one is it will be separately shown under other income. Okay, under other income, you will separately show as government grants, or you can deducted in reporting the related expenses. Okay, let's say you have recorded the expense, and against that expense you have received that government grant, so you can directly deduct and also show, or you can separately show it in other income. Basically, this is your P&L. You can either directly, if here is your expense, you can directly deduct from it and show it. Sorry, if here is your expense, you can directly deduct and show it, or you can also show it separately as other income. So it is depending on you. You have two methods, you can choose whichever you want. Presentation of government grants in the statement of P&L, not in the P&L. Okay, this is in cash flow statement. You will show it as receipt under financing activity. You will show it as receipts under financing activity, right? It is increasing, it's an inflow of cash, right? So under your financing activities, it will be coming, right? And disclosure in FS, accounting policy adopted will be whatever accounting policy was adopted will be disclosed. Method of presentation in FS, nature and extent of the government grant recognized in FS. These are the disclosure requirements, right? Just change it here. It's presentation of government grants, not in statement of P&L, in cash flow statement. In cash flow statement, it will be shown as financing activity. It will be shown under financing activity, right? So just change this. And important note, in case you receive any grant from a private party, then that will not be recorded under this standard. In case you receive any grant from a private party, then that will not be covered under this standard, right? Now, some special points. Quite towards the end of the standard we have come. It's quite easy, right? So, let's look at the special point number 1, which says forgivable loan. What do you mean by forgivable loan? It refers to loans where the lender waives the repayment under certain condition, where the lender will waive the repayment of that particular loan amount under certain condition. If that particular loan, such type of forgivable loan, is received from the government, then it is treated as government grant. Right? I have some entries also here. I'll show you that as well. So have a look here. Okay. So what are forgivable grants? Forgivable grants is nothing but it refers to loan where the lender will waive the repayment of that particular loan on certain conditions being fulfilled. And in case such type of forgivable loan is being received by the government, then it is treated as a government grant, right? So the entry will be what? The treatment will be loan to P&L account. You will defer the grant amount that you get in case there is a fulfillment of condition that needs to be done, because in case you don't fulfill, then it is not a forgivable loan, right? So you will defer the grant. And in case you receive a government loan at a price at an interest rate which is less than the market interest rate, you receive a government loan at an interest rate which is relatively lesser than the market interest rate, then you will treat it as a government grant, and the loan will be recorded in the books as present value of the future, at the present value of actual future cash flows, discounted using the market interest rate, discounted using the market interest rate. So the standard says in case you have received a government loan at the interest rate which is relatively lesser than the market interest rate, then that particular government loan will be treated as a government grant, and loan will be recorded in the books at the present value of the future cash flows, discounted using the market interest rate, discounted using the market interest rate, market interest rate. And the difference between the present value loan and the actual loan amount received is treated as grant, and the difference between the present value of the loan and the actual loan amount is being treated as your grant, is being treated as your grant. And repayment of government grant related to income, apply first towards any unapplied. So in case you have any deferred credit remaining, first you will adjust with that, okay, and the remaining will be taken to P&L, right? We have already seen this, and the remaining will be taken to P&L. But in case initially itself everything was taken to P&L, then during the time of repayment also you will adjust the entire, you will take the entire amount to P&L, right? It depends on your initial treatment, I already told you, right? Next is government grant related to expenses and losses. Government grant related to expenses and losses. In case grant for expenses is already incurred, okay, in case that expense has been already incurred and grant as an immediate financial aid, or okay, these are any one of the two cases. In case the government grant has the grant expense has already been incurred, and or the grant is being given as a immediate financial aid, then you'll recognize in the P&L immediately in the year which it becomes receivable, similar to that of income, right? All other cases recognize it in P&L on a systematic basis over the period in which the entity recognizes the related cost for which the grant was given, right? We have already covered this point already under income itself. I have covered expenses and losses as well, right? So these 2 points have already been covered, right? So this was all about treatment of government grants. It's a relatively very easier and smaller standard, right? Nothing much complicated here. You just need to properly know how it is going to be treated, and based on the treatment the repayment will also reflect, and the disclosure and presentation are important points to remember in this standard, right? So that is all about it. So once you're done revising it, we expect you to go through the ICR solutions, which will give you a lot more control over the entire standard. Thank you so much.